Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a China expert. We had him back in November 2022. He actually nailed what the Federal Reserve Bank was going to do. He used the Thanksgiving analogy about overcooking the turkey with the rate hikes. Here we are after 12 months of rate hikes, and it looks like the Fed has definitely overcooked things. But first, I want to ask him a lot of China and Chinese economy related questions. He is the chief strategist at Macro Lens. Before that, he was a hedge fund manager at a China-focused hedge fund from 2011 to 2018. Brian McCarthy, thank you for joining me again.
Great to be back.
So, Brian, we're recording this interview on Thursday, May 4th, 2023. I want to get your thoughts on what another hedge fund manager said on his macro podcast. Mark Yusko was talking about how really since October, the People's Bank of China has created about $1 trillion worth of liquidity to help with their banks. Is China doing kind of bank bailouts similar to what the Federal Reserve Bank did in 2008 and 2009 to try to, create a soft landing for their real estate bubble?
So I don't really see it that way, to be honest. Now, that is not to say that there haven't been unusual things going on in the Chinese money market. From one perspective, you could say that technically there's been some degree of quantitative easing going on because they have, in fact, injected a lot of liquidity. However, China runs their system a little bit differently. I mean, they are targeting, so the policy in China, monetary policy in China doesn't start from the central bank. So I think let's start at 10,000 feet. If you think about how the Fed tries to affect the economy, they're tweaking interest rates and they're tweaking their balance sheet to try to motivate the banking system to create more liquidity if they want to pump things up, or create less liquidity if they want to deflate things, which is what they've been doing for the last year or so. So again, monetary policy is tweaked to alter the behavior of the banks. China, it works the other way around. They start with a target for how the volume of loans the banks will make over the course of a year. So from a big picture sense, is China easing policy this year? We don't really know. The way you could answer that question is if you knew what the internal loan targets were. And now my speculation here is that the targets for bank lending in particular and credit growth more broadly are largely unchanged on last year. I mean, it's going to be more money lent, but by 8 or 10%, which is a very low rate of credit growth in China. So let's start there. The central planters in China, by my estimation, did not say, let's pump things up in 2023. What they said was, let's keep a steady and, from our perspective, moderate growth rate in credit to try to, keep this housing market from blowing up in either direction. Obviously, they don't want the bottom to fall out. There are a lot of unfinished apartments that need to be completed, or people are going to be protesting. They need to have enough credit out there to get that done, but they are not going back to the sort of the 2015, 2016 playbook, or the 2009 playbook, or the 2012 playbook, where they pumped up credit growth to 20%. You saw a very strong rally in real estate markets and big demand for commodities out of China. So again, the first thing they do in China is say, how much money are we going to have the banks lend this year? And again, it's not going to be significantly, it's not going to accelerate in terms of the growth rate from last year. Okay, so they're not pumping up the stimulus. I think that's the most important thing. Now, in terms of what the PBOC is doing, they target the interbank rate. It's around 2% right now in China, which is low from a Chinese perspective, but against the backdrop of a rapidly deflating housing bubble, it's probably not low enough. But again, they're targeting the 2% rate. So when somebody says they've printed $1 trillion, or however you want to do the calculation, what they're saying is that they have injected liquidity into the banking system at a pretty aggressive rate relative to history. So they make loans to banks. They cut the required reserve ratio, which frees up a lot of liquidity. And by various means, they have injected funds into the interbank market. Yet, that interbank rate is still, it's trading north of 2%, okay? So they have had to inject a high volume of funds to prevent the interbank rate from rising above its target. Okay, so there was a quantitative response in terms of printing money, if you want to call it that, by the PBOC, but it wasn't to ease policy. It was to prevent a policy tightening by allowing that rate to rise. Now, it is very interesting, unique, and I'm going to say strange that they have had to inject so much liquidity to prevent that rate from rising. And it's not entirely clear where the pressure stems from. There are a couple suspects we could point to. One, bank lending has been accelerated in the first 4 months. So the more loans the banks make, the more reserve liquidity they need on their balance sheet to make those loans. Okay, so there was pressure from accelerated bank lending. Okay, but that stems from two things. One, the banks are desperate for net interest margin. Their margins are getting squeezed. You may have seen some of the reports of people repaying Chinese mortgage debt early. These are high-rate loans that are getting repaid on them more quickly than expected. So the banks are getting their money back when they don't want it back. They're really desperate for net interest margin. So if Bank XYZ has a quota of 500 billion RMB to lend out this year, just to pick a number, they want to get that out the door as quickly as possible in the calendar year so they can start that net interest clock ticking and start making money. Because once they get to 500 billion, they have to stop, right? So if they dole out 50 billion a month for 10 months, that's one way to do it. Or if they do, 200 billion in January, 200 billion in February, 100 billion in March, they've hit their quota, but now they're getting net interest margin on the whole thing pretty much all year. So it's a way Chinese banks try to sort of rig the system to get as much net interest margin out of the loans that they are the loan quota they get for the year from the central planners. Okay, so that's the first thing. So we've had accelerated loan issuance in the first quarter, but that will be made up for, if my view is correct, that they haven't loosened the policy dramatically. Then we'll see a sharp slowdown in loan growth in the second half of the year. But the acceleration has created some pressure. The other problem they have is that the shadow banking system is stagnant to contracting. Okay, so trusts are off balance sheet entities that intermediate a lot of credit in the Chinese system. Because of the growing perception of credit risk on the part of Chinese investors, people are less interested in investing through trusts, which don't entail the same kind of implicit guarantee as a bank does. So trusts have had trouble raising and lending funds. That portion of the shadow banking system has stagnated. And the really interesting one is that corporate bond issuance has collapsed. And again, I think this is it's like an intermediation problem. So nobody wants to take the risk. Chinese investors are not buying wealth management products. So wealth management products are not growing because Chinese retail investors, they don't want to hold the credit risk. So they want to invest through a bank-associated product where the bank carries the risk. And if that's a bank deposit, which doesn't yield all that great, so be it. They just don't want the credit risk. So WMPs are shrinking. Trusts aren't growing. Corporate bond issuance has collapsed. This puts even more pressure on the banks to extend credit through loans. So we probably will get an acceleration of bank lending this year. It will come at the expense of this contraction in other forms of credit through the shadow banking system. So again, long-winded intro here, but no major easing of policy from a volume of credit perspective. A lot of pressure on the banks to extend what credit will get extended. That is putting pressure on the money market, which is forcing the PBOC to have to inject a lot of liquidity to prevent rates from rising. I'm just going to make one last comment here, which is that it is also likely that we're starting to see counterparty concerns within the Chinese interbank market. Okay, so if Chinese banks don't want to lend to each other, then the PBOC increasingly has to intermediate those relationships in the interbank market by giving each bank the liquidity it needs, because certain banks are hoarding liquidity because they don't trust their counterparties. So again, if all of a sudden the central bank has to inject a lot of liquidity to keep the interbank rate from rising, they're responding to something bad that's happening in the credit creation mechanism. There's something breaking there.
So you don't think that falling real estate prices, commercial or residential, will affect the Chinese state-owned enterprise banks and real estate developers the same way maybe it did here in the United States in 2007, 2008, and 2009?
Well, in a way, what you may be seeing is the beginning of similar effects, right? I mean, really, 2008 was a fracturing of counterparty relationships, ultimately, right? Banks didn't want to lend to each other. Nobody wanted to lend to the shadow banks. Liquidity stopped moving throughout the system, and then we had a massive liquidity crisis. So the fact that the PBOC is having to inject outsized volumes of liquidity into the system to prevent rates from rising could well indicate that we're seeing the beginning of that kind of phenomenon. Now, you also can see they have the built-in mechanism to deal with it, because all of the banks are linked in this state-owned system with the PBOC at its apex. They will be very quick to respond to these pressures. In a way, they'll almost do it mechanistically. So whatever amount of liquidity they have to inject to keep that repo rate at 2%, they're going to do that. And they can do that. Now, all of these policies, easing monetary policy in any dimension, gets difficult for China if we have a 2008 type of thing going on globally. Okay, this is a big question mark for me regarding the Chinese outlook this year. And one of the reasons I've been very bearish on it, and I can't recall if we discussed the reopening thing. It was they probably hadn't even announced it when we spoke last in November. It was, we were speculating about what might go on with the COVID policy at that point in time. But I've been very bearish on this reopening story. I don't think there's going to be much impetus to global commodity demand at all coming out of China's reopening. We can unpack that to whatever extent you'd like. But if the U.S. really hits the skids and we have a sort of a fear-based rush to liquidity in the dollar realm, like we saw in 08, 09, and you start seeing the dollar ratchet higher, then of course that places all kinds of pressure through the exchange rate on the PBOC. That could hinder their ability to provide whatever degree of liquidity is necessary to keep their banks in order. Although in the end, they'd probably choose to let the currency go. And at this point, I don't think I think that actually wouldn't mind a controllable amount of currency weakness. But in a real sort of a deflationary tail outcome in the dollar realm, then all of these things for China become highly problematic. But we're not in that environment yet. I mean, give it a couple of days, right? Who knows? But at this point, the PBOC certainly has the leeway to keep the system liquid through these additions. On this part of the chat, I really do want to highlight that while they have printed a lot of money, it's in response to some increase in the demand for that liquidity. It's not like they're injecting liquidity to make conditions easier. They're injecting liquidity to prevent conditions from getting tighter, which is the last thing they want or need.
So I was going to ask you about the amount of dollar-denominated debt in the Chinese economy in their private sector. So I've been reading a lot for over the years that every time the dollar gets weak on a relative basis, that a lot of Chinese real estate developers were playing this currency game where they'd bet that the dollar weakness would maintain. So they'd go and increase the amount of dollar denominated debt to use for their construction projects. So do you think that's becoming onerous now?
Well, I think it's pretty much blown up at this point. Many of those bonds have been, so, obviously we're not going back to the heyday, the heydays of, go borrowing by Chinese property developers, right? They're not reverting to that playbook. When Xi Jinping and his minions say that houses are for living in, not speculation, I mean, that's serious stuff. He means that. And I do believe that Xi Jinping has made a determination that this credit-fueled growth model, GDP at all costs, is a dead end. He's got nowhere to kick that can. There's nobody next in his mind, right? He owns whatever problems get kicked. Whatever can gets kicked down the road is going to get kicked right at him. He's got nowhere to kick it to. So I think he's done kicking that can. So the real estate. The level of real estate borrowing we've seen in the past, we're not going back to that. But there is a bit of a problem in that because so many of those Chinese real estate bonds have blown up, that is an important window of access to US dollar liquidity on China's part that is now closed. So and there are other windows that might be closed in a stress situation as well. So, one way China can access dollars in a pinch is having its corporate entities borrow dollars on the international market, right? But now these property developers have burned global investors to the extent where that's probably not a cost efficient option by any stretch. The other way China raised a lot of dollars in 2016 when there was serious stress on the exchange rate was through foreign exchange swaps. Basically, Chinese banks borrowing dollars via FX swap through non-Chinese banks. And now we haven't been in a stress situation like that for a while. So I'm only speculating here. But I would guess, given the geopolitical strains and the increased perception of a real geopolitical tail risk in bilateral relations, I'm not sure Chinese banks are going to have the same capacity to borrow dollars via forward foreign exchange contracts with non-Chinese banks as they did in 2016 when the Chinese currency was last under, very, very serious outflow pressures. So, the world's different from 2009. The Fed's got their swap lines, which alleviates some of the concern of this sort of global flight to dollars that causes a dollar melt up. But I'm still very concerned that if this Fed really, really gets offsides, like if this banking crisis continues to head downhill in the US, it's much like what we're seeing in China, right? These situations, people start to worry about counterparties. People want and need liquidity in these situations. And if the central bank doesn't respond, it's really problematic. So if the Fed is really late to waking up to a emerging crisis in the US banking system, I still think you could get very sharp increases in the dollar. And then China is, it's always difficult for them. But the economic problems they have domestically now, overlaid with the much heightened geopolitical risk relative to the last time, 2015, 2016, we got in this situation. And, some of these key windows for dollar liquidity potentially being closed, China could find itself in a policy pickle very, very quickly come this summer or fall.
I don't know if you saw, but Kyle Bass was tweeting out about a month ago. It was around the time that Credit Suisse, before the Swiss government and the Swiss National Bank had basically subsidized the merger with UBS and Credit Suisse. Kyle Bass was tweeting out that it was probably the People's Bank of China that had gone to the Fed's new since 2020 permanent repo facility for foreign central banks and borrowed the majority share of about 60 billion US dollars. He was laying out the case why he thought it was People's Bank of China. Do you agree with him on that?
I mean, I can't say I agree or disagree because it's pretty much it's wild speculation on anyone's part. I haven't really seen the best case I've seen made was that it was the Swiss National Bank for precautionary purposes. Um, but that's just speculation as well. No one really knows. I guess I can't really see why the Chinese would have done that in an environment where their currency really wasn't under any apparent pressure. Now, let me unpack that a little bit because we're in a very unique situation in terms of the financial flows in and out of China. With the big boom in China's trade surplus through the post-pandemic period when, goods consumption was off the charts in the West, it was a real big benefit to China in terms of the flow of foreign currency into China. At the same time, they weren't letting their own populace travel, which is call it a $150 billion source of outflows for them because Chinese like to go to Tokyo and buy $30,000 watches or whatever the heck they're buying. Some of it's sort of tourism mixed with capital flight. But those were significant outflows of foreign currency from China that ground to a halt because the border was closed. So that both of those are now normalizing. Global goods can. So between $500 billion trade surplus and then some at the peak and $150 billion they saved each year by not having their tourists go to other countries and spend money, it was really the golden era for Chinese FX flows in 2021 and 2022. However, strangely enough, we didn't really see a big accumulation. I mean, there was no accumulation of reserves at all, really. But furthermore, the money that should have been registered as entering China through its banks in terms of foreign exchange transactions was hundreds of billions of dollars less than you would have expected if you calculated what their trade surplus was and the money they were saving by not having outbound tourism. So it's very hard to explain exactly the mechanisms by which this capital flight takes place. But again, to sum up, China should have been seeing hundreds of billions of dollars of inflows come through their banks in terms of foreign exchange transactions primarily from the proceeds of these huge trade surpluses. And we just didn't see that. So the Chinese capital controls are a pretty leaky sieve in general. The way they crack down, if they need to, is just sort of a blanket restriction on who can transact in the FX market and when. So I'm sure that Chinese authorities were aware that only a fraction of the trade surplus was revealing itself in a surplus in FX inflows. And I guess because the currency was reasonably stable, they were sort of okay with that. So I do view this as something they allowed to happen. But the point is, there is still relentless pressure on the part of Chinese investors to get exposure to overseas assets at any opportunity. And they took that opportunity in 2021 and 2022 when the money was flowing in through the trade surplus. Now, of course, again, that's all going to turn around because that Chinese trade surplus has peaked out. And if we go into recession in the US and Europe, it's going to crash pretty hard. And at the same time, Chinese investors are starting to travel again. So the RMB was sort of, broadly sideways at a time when the trade and tourism setup for China was as good as it could possibly be. and they're both going to be a lot less good going forward. So again, if you see any kind of strength in the dollar, I think the RMB is uniquely vulnerable to pressure, which would greatly compound the struggles the PBOC is having to try to keep their banking system liquid and keep the banks being able to generate enough credit to prop up the system in the wake of the real estate bust in China, which is, I think, going to be a feature of their financial system for years.
Now, we're also seeing the last couple of weeks, the headlines are literally everywhere in the mainstream media, Fox News, alternative media, that China and a lot of other countries are rapidly de-dollarizing. Have you seen evidence of this in the Chinese economy, that is actually happening, or is this just a false narrative?
So I have been very skeptical of the RMB's ability to challenge the dollar as a global reserve currency. Broadly, I remain very skeptical. Ultimately, it's just not advisable for anyone to store a large portion of their wealth, whether it's a corporate, an individual, or a central bank, in a currency that's not convertible and where there's no rule of law whatsoever, and a long and robust history of the government acting on whim, basically, right? So you're never going to feel safe having your money in the RMB. However, after the U.S. response to the Russian invasion of Ukraine, there is now a much bigger motivation, not necessarily on the part of countries to hold a lot of assets in the RMB, but there is a lot of motivation to establish the means to continue engaging with China in trade and finance in the wake of something similar happening to China. And I mean, even French President Macron said this a couple of weeks ago in what I thought were just inflammatory comments. We've seen Lula from Brazil and a number of others suggest that, like, look, when Russia went into the Ukraine, the United States is trying to tell us we can't do business with Russia. What if Xi Jinping goes into Taiwan and, you're the president of Brazil? I can't have the U.S. tell me I can't deal with China. I mean, we're a poor country. This is basically what India said in the wake of the Russia sanctions, right? The Indian finance minister told us, like, I got 1 billion mouths to feed. I mean, it can't be, virtue signaling in a geopolitical sense. They have realities to deal with. So whether it's out of those, realities of many countries just can't afford not to deal with China, or, Macron's motivations are different, I guess. He doesn't, I guess he was pushing back against U.S. unilateralism in general, but many countries want to retain, they don't want to outsource to the U.S., their ability to deal with China. And so the heavy-handedness with which we dealt with the Russian central bank in the wake of that invasion, basically sequestering all their reserves, it did cast a bit of a cloud and a bit of extra risk over holding reserves in dollars. And it did sort of signal to much of the rest of the world that you need to start working to retain the ability to trade with China, if you so choose, in the wake of a geopolitical shift. And so Saudi Arabia is setting up the pipelines, to use the term, to do business in RMB if it comes to that. In Russia, it has come to that. So they've greatly, increased their use of the RMB for the settlement of trade. Now, if you're preparing to have to settle trade accounts with China, and you have in RMB, and you have a trade deficit with China, which pretty much everybody does, then you do also need to maintain some liquidity in RMB if it comes to that. this really has dramatically changed this like reserve currency equation. It's not because the RMB is a better currency or that China is a better economy or anything else. The RMB still has all the problems it had 2 years ago in terms of being a global reserve currency. It's just there's now an impetus now that is just going to force a lot of other countries to sort of overlook those problems or figure out how to deal with them or just swallow those problems because they're trying to prevent a bigger problem. And the bigger problem is being cut off from trading with China, which, again, is just simply untenable for many. So I really think the way we dealt with the Russian central bank has altered that calculus dramatically, which is not to say China is going to become a rival reserve currency, but
Yeah.
it's. I would have said it would never be more than a rounding error 2 years ago, and I've updated that forecast. I can tell you.
I agree. I don't really see China as the main beneficiary of the U.S.'s blundered policy with the sanctions on Russia for what's happening in Ukraine. I see the beneficiary as physical gold demand. I mean, look at the tonnage purchases that non-G7 central banks have been adding physical gold lately, really since the sanctions with Russia. I mean, there's been huge increases. The People's Bank of China in the last 4 or 5 months has announced a large purchases. So those are surpluses, Brian, that could have been recycled into U.S. Treasuries. Instead, these non-G7 central banks have decided, hey, we saw what the U.S. did with their policies. Instead, we're going to buy physical gold tonnage instead.
Well, as I just said a moment ago, if you want to do trade in RMB with China, you need to maintain some RMB liquidity if you have a trade deficit with them and you want to buy what you need to buy from them in a world where the U.S. has cut themselves off from China and they're trying to cut you off from China. But to your point, if you really hate the idea of holding the RMB, and there's good reason not to like that idea, but gold's probably not a bad alternative because either China will take that in that situation, or someone else will take your gold for RMB. I mean, it's gold will be more useful in generating liquidity to deal with China in the wake of a geopolitical split than dollars will. So from even this perspective of just establishing the wherewithal to continue to trade with both sides in a bipolar world, that probably increases the utility of gold from a reserve perspective as well.
So the average investor in mainland China, so if you're middle class or upper middle class in mainland China, do you have a lot of investment options, or are your options pretty limited because of the capital controls?
It's still extraordinarily limited. And obviously that was one of the big drivers of the real estate boom. And, that party's over. So there really aren't a lot of opportunities for Chinese, sort of middle class households who don't have access to some, it takes a certain amount of capital for it to make sense to actually set up the infrastructure or tap into the infrastructure that's available to move it, right? I don't know what that threshold is, probably in the tens of millions, but I don't know, maybe a few million. If you don't mind paying a pretty hefty VIG, you could probably find a way to move some portion of that. If you get a few $100,000, what are you going to do? You're sort of screwed, which is why there's been a huge increase in the holding of bank deposits by Chinese households. And, there's been a lot of debate about this with regards to this reopening trade, because, China didn't have the stimulus we did. They didn't print $5 trillion and give it away. They didn't give people much of anything. There were some little tax breaks, and that was really about it. Yet we did see a big spike in the holding of bank deposits by households. And I think largely that is out of the reality that there's just nowhere else to go, really. And, maybe you get paid a couple percent in a bank deposit. And if the currency declines by 5% this year, you're only down 3%, and that's the best you can do. I mean, I don't know. It's certainly it's certainly better than losing, 20, 30, 40% buying real estate here, which I would think was what's going to happen over the next few years in China. So, again, for those households who don't have I think, whatever the hurdle number you need to make it, worthwhile to pay whoever you need to pay to try to get money offshore. If you're under that amount, you're really, and probably hundreds of millions of people, in this group, there's really not a lot they can do.
Well, one of the new options that's been increasing lately is physical gold demand. So I don't know if you've seen the amount of data from the Swiss gold refiners. So China's import data is normally crooked. I've gotten that confirmed from other hedge fund managers that also pay attention to China. So their imports and their exports never really match. But the Swiss export data into China, physical gold tonnage has spiked a lot really since November. I think it's the most since 2017 or 2018. So there's about, I think, 500 tons of additional private sector gold demand that's gone into mainland China just the last couple of months. So either they're parking cash, like you said, or they're buying gold. So these are kind of like bankruptcy deflation options. Or I guess gold's kind of a currency instability hedge too. So it's inflation or deflation. As long as the currency is not stable, gold's a pretty good option historically.
Yeah, I would think it would look great from the perspective of a middle-income Chinese investor, for sure.
So as we wrap up the interview, I have a couple of questions now on the Fed. So back in November of 2022 was the last time you were on. Use the Thanksgiving analogy that the Fed was going to overcook the turkey. And here we are after 12 months of interest rate increases. It looks like the Fed now has put the car out of control. They've slammed on the brakes too quickly. And now it looks like there's going to be a lot of regional bank problems. Do you think that we're going to see a major bust, a major banking crisis here with regional banks here in the United States and commercial real estate problems going forward?
Yeah, I think it's in progress, unfortunately. In monetary policy, as in life, two wrongs don't make a right. And, it's clear that the Fed was late to recognize the inflation problem. I mean, I can even sympathize with that. We hadn't had inflation in decades. The pandemic stimulus was completely unique. Now, in hindsight, it's completely clear that the $5 trillion went directly into bank deposits, basically. You goosed M2 by, call it 25% above trend. And as the textbooks would tell you, over some time frame, like the price level is going to rise 25%. Well, the M2 is now shrinking, so it's not going to be the full 25%, but we'll call it roughly 20% increase in the price level. We're now back to an equilibrium. So the M2 in the US, deflated by CPI, real M2 is back to the pre-pandemic trend. So you had a big spike in the money supply, and then they tightened and M2 started to shrink and prices rose. So the economy grew into the newly inflated monetary supply. And if you think about it, if the price of everything's 20% higher, then you're going to want 20% more cash in your pocket walking around to do your daily business. So basically, you need 20% more money supply now because the price of everything's 20% higher. So to my mind, from that perspective, we're basically returned to an equilibrium. It's unfortunate that they, printed the $5 trillion and helicoptered it into everybody's account, and we had this big inflation, but it's largely run its course now. So the Fed made the mistake of accommodating the stimulus. The political class made the mistake of enacting the last stimulus, which I think everybody can now see was overkill. So those mistakes were made. And I think, as we probably discussed last fall, there was no way to fix that. Once that $5 trillion was printed, unless they were going to tax the money back, that horse was out of the barn. The inflation wasn't even really preventable at that point. But now, because the Fed is looking at lagging indicators like services prices, which are literally in the index of lagging indicators, and wages, which are the last thing to respond to a monetary shock. Commodity gold prices go up first, commodity prices go up, goods prices go up, then services prices and wages.
and they're focused on the very end tip of that tail. So, they were behind in responding to the inflation. They've over tightened, and they're behind in recognizing that the inflation is over. So why is this such a big problem for the banking system? If you look at it's not only that they've over tightened, it's the scope of it's the scope of the mistake in each direction. So if you look at like First Republic, which went belly up over the weekend, dramatic increase in their assets in the period 2020 to 2022. So their mortgage book at the end of 2019, 48 billion. By the end of 22, 98 billion. It doubled. Why did it double? Because like everybody else, they got flooded with these deposits. What is a banker going to do if you flood him with deposits? He's going to make loans. That's what they're born to do.
Or buy treasuries, yeah.
Yeah, or buy mortgage-backed securities or whatever, right? They're not going to sit on it. Like they're in the business of using those low-cost funds to invest in something at a higher yield. That's what they do. So we had rates on the floor at zero. We pumped, $5 trillion into the economy. The deposit base ballooned, and like these banks dramatically grew their assets at yields that were on the floor. Right? So the problem at First Republic wasn't credit risk yet. That's coming. It was all these mortgages they made at 3%, and now the mortgage rate's at 6%. Nobody wants those assets. And they can't fund them because now the deposits start leaving. Now they have to borrow it from the Fed at 5% to fund assets that yield 3%. It's over. It's lights out. So it was the volatility, the extremity of and aggressiveness of the policy in both directions, easing and then tightening. I almost don't blame the bankers. I mean, you look at an individual case and you say, yeah, what was First Republic doing, doubling that book? But I mean, it's very, very hard for the system to handle this degree of policy volatility, which, by the way, is the biggest argument going for a gold standard. But let's not fall down that rabbit hole here, right? But I mean, how are people supposed to cope with this? And again, if you want to defend the Fed, it was unique circumstances, 100-year storm. We had never seen this before. I get all that. But the reality is very, very aggressive easing. They overcooked it. And then I have very little sympathy for the over tightening because, as you noted, I've been saying for 6 months, it seems anybody who understands why the inverted yield curve is an important signal of recession. It's not just like any other indicator. The inverted yield curve it brings its own forecast to fruition. Why? Because banks can't survive when the short rate is 200 basis points higher than the long rate. So it's crazy to me. I'm having conversations with people who still refuse to acknowledge that there's a connection between aggressive hiking and the most inverted yield curve in 40 years and the fact that there's a bank blowing up every 3 days now. Like, come on. Obviously, the crux of the problem is that the Fed took the short rate well above the long rate, which is a proxy for the market's estimate of the medium-term equilibrium rate. That's why the curve signals they're tight, because they have the short rate well above the market's estimate of the equilibrium rate over the medium term. Policy's way too tight. They don't get it. These regional banks, look, there's another problem here, which is, the Western Alliance, the one that's in the crosshairs today. Very simple analysis. You can look at all these banking analysts who say, oh, they have a great franchise, they have that, I like the stock, for whatever reason, they do pages and pages of analysis. I'll give you a 10-second analysis. It's 3 clicks on Bloomberg. Their assets are $77 billion, and their tangible book value of equity is $5.2 billion. What more analysis do I need to do?
So you're saying their balance sheet.
They're levered 15 times. They're levered 15 times. And long-term interest rates, particularly in mortgage rates have doubled. They're levered 15 times. They're a bank, and mortgage rates are doubled. What more do we need to know at this point?
Well, what I also see coming, Brian, is these banks, these insurance companies, these pension funds, they haven't marked to market their losses on the older bonds, so the corporate bonds and the U.S. Treasuries they bought years ago, now that the Fed has raised interest rates. So there's a lot of mark to market losses. I think the bank analyst, Christopher Whalen, said the banking system is sitting on about $5 or $6 trillion, his estimate's worth of losses right now if they mark to market everything. And I don't even know if that includes the commercial real estate. I think the largest bubble, and it's only the first inning, since we're both baseball fans, we'll use this analogy as the commercial real estate bubble. I don't even think we've seen the majority of the pain yet from that. I think it's really just starting.
Absolutely. We're talking about losses on securities from what in the bond world is called duration. Okay. So these are long dated income streams of fixed payments at yields that are much lower than the market rate right now. So, these mortgages in particular, like people are never going to repay these more. They're never going to refinance these mortgages, right? I mean, we see housing supply collapsing because somebody with a 3% mortgage can't move. So these assets are going to pay back in 30 years. So a bank is now stuck with that 3% coupon for 30 years. That's a huge problem. So we're talking about these duration losses, which, to your point, the accountant said, don't worry, put it in this held to maturity book, and you'll get par eventually. The problem is, we're going to wait 30 years to get par back, but meanwhile the Fed's got rates at 5 and it yields 3. How am I? How are you supposed to fund that book? But
isn't held to maturities in theory, right? But if you're a regional bank and all of a sudden your depositors see this, or see other regional banks failing, the depositors start pulling the cash out, then you can't hold to maturity because the bank has to look at their balance sheet and say, we need to go raise capital.
Right. Well, the deposits pulled out and they thought they could fix that by saying, well, the Fed will just step in and lend the money. But the Fed's lending money at 5%. It can't survive it. But to your point, we're not even talking about credit risk yet. So the dynamic that's taking hold, that I think taking hold like irrepressibly at this point, is that the regional banking system is going to shrink. We're destroying the capital base. We're destroying the loan making capacity of the system as we speak. Regulators are now up the backside of every bank in the country. They're already talking about more stringent regulations. Everybody knows that's coming. The funding cost has risen. Funding instability is extreme. Every banker, they're hiding under their desk. They're curled up in the fetal position under their desk right now. The mandate at every one of these banks, I'm sure, is like no new loans, shrink. So what's going to happen now is liquidity is going to tighten. The economy is going to slow. Nobody's going to roll any of this commercial real estate stuff. And now you're going to see defaults because, M2, by the way, is shrinking at the fastest pace in the history of the data set. So we're heading into a liquidity crunch. And I think this is why these bank stocks are getting obliterated. The market's not stupid. They know that, like, if you look at the securities losses, these banks have very little capital. And now we're going to go into a credit cycle because the Fed's hiking rates into the teeth of a banking crisis. I mean, I'm laughing because it's laughable. So, yeah, there's more to come on the banks thing, unfortunately. And to my point earlier, if it really gets to a big risk off, a liquidity crisis, the dollar can strengthen very sharply. And now you've got China in a pickle, and you get all kinds of other problems emerge from that. So, how can they fix it? If the Fed comes out tomorrow and cuts by 150 basis points, I'll be in a much better mood. But I don't think that's very likely.
Probably a new alphabet soup liquidity program. I mean, it looks like this new one, BTFD, or what? I think I missed the abbreviation. That's a different abbreviation for a different thing in finance. But whatever this new, yeah, that was a Freudian
like it, doesn't it?
That was a Freudian slip, but whatever this alphabet soup is for the regional banks, I mean, it seems like that. Do you think that's a bailout then if the Fed is loaning at par for stuff that's probably not even worth 70 cents on the dollar?
Yeah, it's dangerous, which is why. So, some people are saying they should not resolve these banks like PacWest and whatever else hits the wall here, Western Alliance. They should just let them continue on, let the Fed lend the money and pretend they're fine, and just let them be zombie banks, because every time they resolve these things, it just gets worse. Um, the problem with that is that the Fed legally can't be lending money to firms that are insolvent. And if they start funding the entire system under collateralized, to your point, they're lending $100 on a bond that's worth 82 cents or 82 bucks rather. And they continue to lend to insolvent institutions. There's a very good likelihood the Fed ends up taking big losses, which they're not supposed to take. And it's just out of bounds. It's just not it. And furthermore, it's not credible to have a bunch of banks operating when they're priced at 10% of their book value, because the market knows the capital is not real. I mean, this, again, to your point on these hedge held to maturity securities, the part of what's happened here is there's like an accounting fiction that's been exposed. Like you can say they don't have to count the losses, but now they're going to ask the market for like an equity recapitalization. So are new equity investors supposed to pretend those losses don't exist too, and pay $1 for something for a bank that's only worth 20 cents? No, it doesn't work that way. It doesn't work that way.
Yeah, I
So, like,
agree.
we've exposed the accounting is problematic. Obviously, the regulation was crap because these banks are all levered like 12 to 14 times. The risk weighting on treasuries is zero. Like, duration risk was not a thing. It's mind boggling that after what we went through in 08, 09, they have screwed the pooch again. But you know what? They have themselves to blame, because frankly, if the Fed had just stopped at 3.5% to 4%, none of this would be happening. And the inflation would be coming down all the same, because it was that one-off burst of money printing and fiscal accommodation that was a one-off. It was a one-off. That inflation was going to run through the system come hell or high water. This was all completely unnecessary. That's the tragedy of it.
Yeah, I agree. And I think the Fed has basically created another banking crisis, especially for the regional banks. Now, I think the larger banks like JP Morgan, they're going to get to asset strips. So the FDIC and the Fed are going to subsidize them going in and buying whatever assets they want. They're not going to have to deal with any of the toxic problems that the regional banks are. But I don't see a lot of regional banks surviving this. And I think even if the Fed were to cut rates, like you said, 150 basis points now, I think the damage is already done. I don't think a lot of these regional banks can go to the market and go raise a lot of capital. So I think they're in major trouble. And this is before the commercial real estate problems really started. I think at this point, it's a cash flow problem with rents. It's an occupancy problem. It's not just an interest rate problem with commercial real estate. There's too much supply. There was a teardown boom, Brian, for about 15 years. I don't know about your area, but I'm in the DC metro area. And I've spoken with real estate developers here. And literally, when interest rates were cheap, they were borrowing as much as they could. They were going to investors and they were tearing down whatever they could in terms of an old house on an expensive piece of land and building a McMansion, or tearing down a 1 or 2 floor strip mall and building a giant office park or a mixed use building with 2 floors of premier office space and like 7, 8, 10 floors of luxury condos. And that's been going on here in this area for 15 years.
Yeah, I know. I'm here in Stamford, Connecticut. They're building apartment buildings like there's no tomorrow here, and there's a major glut of commercial real estate. So I'm with you on all that. It's going to be interesting summer, I think, in the financial markets.
Well, I can almost guarantee bet that the Federal Reserve is going to screw things up further with bad policy pulling the levers. So I think that's why the market is kind of realizing, this risk off strategy of the barbell strategy of holding cash, US dollars and gold. And there's a lot of people that are in kind of that camp where they want dollars and they want gold.
Yep, I like long duration treasuries, which are performing pretty darn well, but I think there's a lot more there too. The entire interest rate structure eventually is going to return pretty much to where it came from.
So you think then the Fed will have to do a 180 at some point and kind of copy the Bank of Japan and go into yield curve control and expand its balance sheet to either save the banks or real estate?
It depends on what the fiscal backdrop is like and who's pulling the strings there. If the current administration's still in power, it looks like they're going to get another 4 years, then I don't think we'll have to do the Japan thing, because there's likely to be, assuming that they have control of Congress as well, there would be serious fiscal easing. But yeah, I think the Fed's going to pivot, and they're going to pivot very, very hard at some point. The problem is they're going to be stubborn. They're going to, they're still looking at lagging indicators. We're going to start to see economic weakness, I think, imminently, and they're going to say, "Well, this is what we were looking for." We wanted the economy to slow, and they're just not going to want to acknowledge this mistake until it's forced upon them, and then they're going to have to be very, very aggressive. Well, and it is an election year too, so there'll be. I think inflation is going to come down very hard over the course of this year, which will free them up to ease very aggressively in 2024 into the election.
Well, I can tell you from listening to a lot of people in both political parties here in DC that there's very few people who want to actually decrease the amount of government spending. So they're almost all talking about increasing the government spending. I mean, even the Republicans who are fighting the Democrats on raising the debt ceiling, they're talking about cutting this and cutting that. It's just a slower amount of spending increases. It's not a real actual cut where it's massively cutting the government spending.
Right.
So as long as DC keeps spending, I mean, someone's going to have to buy the treasuries. And Brian, it just does not look like the normal buyers of U.S. treasuries the last 15 or 20 years. So China, Germany, Japan, who would normally recycle those giant trade surpluses back into U.S. treasuries, those are no longer the buyers. So I'm wondering who's going to end up buying the treasuries then.
Yeah, somebody always buys them. There's always this kind of concern over who's going to buy treasuries. I mean, you've got plenty of demand from pension funds, insurance companies, and if you're in a low rate environment, if you've got a low central bank rate, not very good prospects for business investment, low demand for investment, a low neutral rate, then it's basically it becomes an arb bid. It's an arb bid. I mean, if demand for treasuries is really weak, you can get a little widening of the term premium, although we haven't seen that for years. But ultimately, if short rates are low and people expect they're going to stay low, then long-term yields will be low. Otherwise, somebody will arb it.
I mean, at some point, just on a math problem, Brian, we're looking at the amount of U.S. government spending with interest payments on the debt now, military spending, entitlements. That takes up a large chunk of the tax receipts. So I just in terms of a math, I mean, the Fed's going to have to go to Japanification yield curve control at some point, because the interest payments on the debt are around $900 billion a year, and you add that into around $900 billion of annual military spending, and then the entitlements. It's just taking up too much of the tax receipts.
I mean, maybe, but you have to keep in mind that the phenomenon you're talking about really wasn't associated with yen weakness in Japan for decades. So, if the neutral rate is really, 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 really low for whatever reason, whether it's Japan's case, the population is shrinking, or a massive real estate bust, and very low demand for investment, whatever the heck it might be, terrible government policy, which is a deterrent to investment. If the neutral interest rate is really, really low, then you can have really, really low interest rates without currency weakness, which is pretty much what Japan saw through the 90s and 2000s, and really until 2 years ago.
Well, Japan was the only country doing this, right? And then also they were buying a lot of U.S. treasuries, and that was during a U.S. Treasury bull market. So they're adding a lot of U.S. treasuries during a U.S. Treasury bull market too.
Yeah, I mean, the phenomenon you're talking about is like It's almost like an emerging market crisis. You need a crisis of confidence, and no one has any idea what like where that breaking point is. I'm not saying it couldn't happen someday, but it's really, I don't know, it's really extreme to see the world just sort of flee from dollars into,
Oh, I'm not predicting de-dollarization rapidly or a dollar collapse or anything. I'm just saying that the Fed's going to say that the US government doesn't want to pay a high interest payment, and so they're going to come in and they're going to buy the treasuries and try to cap the yields. And I think the dollar's not going to, I don't think the dollar's going to collapse or anything like that because of it. Because I mean, every time the dollar's weak anyway, demand for dollars grows, dollar denominated debt has grown because you have these foreign governments and foreign corporations. They play this currency game that when the dollar gets weak, they want to borrow more in dollar denominated debt.
Yeah, I guess I don't think so. That wasn't really the motivation for yield curve control in Japan, which, as an aside, is just a policy I absolutely hate. I hate it. I've always hated. I hated it when they did it, and I think I was sort of right to hate it, because the reason I hated it was that if you if you really end up with that rate off sides, things can go very, very haywire. Which is what happened in Japan's case. Like, basically, when global rates rose well above where the Bank of Japan had the 10-year pegged, then it becomes a real counterintuitive policy, because you're trying to cap rates by buying bonds, but you're buying bonds with printed money. So you're basically doing QE to cap rates. The currency falls, inflation expectations rise, the market wants even higher rates. So you're doing more. It's like, and really, if the US hadn't hit the skids, and like the Fed sort of overcooked it, now once we go into recession, global rates will come back and Japan will be bailed out. But it was really starting to go haywire in Japan. And you can easily create a currency meltdown in that scenario. And we did see the yen sort of almost go parabolic for a while there. It didn't quite break. But again, it's just, you end up in a very, very bad place when you're trying to cap yields via a mechanism which actually raises the equilibrium nominal yield. So it's like a cat chasing its tail.
Oh, so I never said it was a good policy. It's normally a desperate policy. I mean, like the US DC won't cut spending, and the Fed says that DC needs to focus on fiscal policy. But then the Fed has been the great enabler for the last couple decades for enabling DC to keep spending more. But as we wrap up here, Brian, I want to thank you so much for your time. I've kept you for over an hour. If my listeners want to check out Macro Lens or follow you on Twitter, how do they do so?
Yeah, I'm on Twitter at Brian Gobosox, BrianGoBosox on Twitter.
And I'll attach a link to the Macro Lens website. Again, I want to thank you so much for your time. And we did have some audio problems. I'm going to edit this together, and I'm sure it'll be a great interview.
Sounds good. Thanks a lot. It's great to catch up.